You know that feeling when you're just trying to keep up, but there's just so much information coming at you.
Yeah, it's like drinking from a fire hose sometimes.
We totally get it. And that's really why we do this, the deep dive. We take the stuff you send us, articles, research, and try to really dig in.
Exactly. Cut through the noise, find the core ideas. That's the goal.
And today we're diving into something pretty fascinating, actually. It's a concept from international finance called the Triffin Dilemma.
Yes, Triffin. It sounds a bit academic, maybe, but it came straight from the sources you shared, and it has some really big implications for how global money works.
Right. So our mission today for this deep dive is basically to unpack it. What is this Triffin Dilemma?
Uh-huh. And how has it actually shown up in history? We've got some key examples.
And importantly, why does it still matter? Why should you care about it today?
And we'll try, as always, to keep it clear,
Right.
engaging, no jargon if we can help it. Hopefully you get some interesting insights out of it.
Okay, let's do it. So the Triffin Dilemma. It's named after an economist, Robert Triffin.
Right.
And it basically describes this fundamental tension, a conflict, really.
Yeah, conflict for countries whose money ends up being used all over the world, the main reserve currency.
So Triffin saw this inherent problem. If your currency is the global currency, you're juggling two things, aren't you?
Exactly. You've got your own economy's needs, your domestic policy,
Uh-huh.
but you also have the world needing your currency for trade, for reserves,
Yeah.
like a safe place for other countries to park their cash.
Okay, so if everyone wants your dollars or your pounds or whatever,
Yeah,
you need to supply them, right? Get them out into the world.
you do. And one source, Wikipedia, mentioned the usual way this happens is through trade. It
Mm.
actually used the phrase inevitable trade deficit.
Inevitable. That sounds counterintuitive, maybe. Running a deficit to be strong.
It does seem a bit weird at first,
Yeah.
but the thinking is, as global demand for your currency grows, you need to send more money out than you bring back in from exports.
Ah, okay. So that net outflow of your currency, that's what looks like a trade deficit. You're buying more stuff from the world than you're selling.
Precisely. And the source pointed out, that's pretty much the story of the U.S. dollar, especially after, the direct link to gold ended in 71.
Right, and then the petrodollar system kind of solidified things later.
Yeah, and by around 1985, the U.S. flipped. It went from being a net lender to the world to a net borrower.
Basically accepting that running these big trade deficits was just part of the deal, the price of having the world's money.
It seems that way. And those deficits are huge now, like $1 trillion a year just in goods.
Wow.
But here's the catch. Here's the dilemma part. If you're constantly pumping out your currency, running up debts,
People might start to worry.
exactly, other countries holding your currency might think, hang on, is this sustainable? Is this currency going to hold its value if they're always spending more than they make?
Ah, so the very act of providing the currency the world needs.
Can eventually undermine confidence in that currency.
Yeah.
It's a fundamental paradox. Supplying the dollar sows the seeds of doubt about the dollar.
That's the core tension. Okay. Now, Wikipedia did mention a couple of other ways to get dollars out there besides just trade deficits.
Right, you mentioned foreign aid.
Yeah, direct aid, and also something called swap lines. What are those exactly?
Okay, so foreign aid is pretty straightforward, just giving money directly to another country. No immediate trade involved.
Mm-hmm.
Swap lines are a bit different. Think of them as agreements between central banks. Like the Fed agrees with the European Central Bank to temporarily swap dollars for euros.
Okay, so it's like a short-term loan between the big banks.
Kind of. It helps other countries get hold of dollars if there's a shortage, maybe during a crisis, without them having to earn them through trade immediately. It provides liquidity.
Got it. So different ways to supply the currency, but the underlying tension is still there. It sounds like a really tricky balancing act.
It really is. Always trying to meet that global demand, but also keep everyone believing in your currency's stability.
And this isn't exactly a new realization, is it? The sources mention John Maynard Keynes.
Keynes, yes. Way back when they were setting up the Bretton Woods system after World War II.
He apparently saw this problem coming.
He did. Remarkably insightful. He worried about relying on one single country's currency as the world's reserve. He saw the potential conflicts.
And he proposed something else. Bancor.
Exactly. Bancor. It was his idea for a supranational currency, not tied to any one nation.
So managed internationally to avoid that conflict of interest.
That was the hope, to sidestep the very dilemma Triffin later described. Now, the closest thing we have today are the IMF's SDRs, special drawing rights.
Right.
But as Wikipedia noted, they haven't really taken off enough to, replace the dollar in a big way.
Okay, so we've got the basic theory down, the conflict, the supply mechanisms, the potential confidence issue. Let's look at history.
Yeah, the real-world examples make it much clearer.
Our sources pointed first to the U.S. dollar under Bretton Woods. That system set up after World War II. Walk us through that.
Okay, Bretton Woods. The basics were the U.S. dollar was fixed to gold, $30 an ounce, solid promise.
Pegged to gold.
And then other major currencies pegged themselves to the dollar. So the dollar became the anchor, the main reserve currency everyone held.
Okay, so world needs dollars for trade, for reserves, just like Triffin said.
And the U.S. had to supply them, which meant over time, the U.S. started running what are called balance of payments deficits.
Which just means more money flowing out of the U.S. than coming in, right? Spending on imports, military bases overseas, stuff like that.
That's the idea. Global growth needed more dollars. The U.S. supplied them, often through these deficits. And foreign central banks started stacking up huge amounts of U.S. dollars.
And here comes the problem.
Here comes the problem. Eventually, the total value of all those dollars held outside the U.S. got much, much bigger than the value of the gold the U.S. actually had in Fort Knox to back them up.
Right. It's like writing checks you can't actually cash if everyone shows up at the bank at once.
Exactly. And some countries notice, the sources mentioned France, under de Gaulle, was particularly vocal.
They started asking, hey, can you really give us gold for all these dollars if we ask?
Yeah. Confidence started to fray. Not necessarily in the dollar's usefulness day to day, but in that specific promise, the gold convertibility.
Because the deficits needed to supply the world with dollars were making it impossible to keep that promise.
Precisely. The system's internal contradiction was showing. People started betting against the dollar, speculating that the U.S. would have to break the link.
Which leads us to the Nixon shock, August 1971.
Yep. Nixon went on TV, announced the U.S. would no longer swap dollars for gold. End of story for Bretton Woods.
So the system broke down because of that core Triffin tension.
You could absolutely argue that. The need to supply liquidity clashed with maintaining confidence in the gold peg. It became unsustainable. The dollar stayed dominant, but that specific guarantee, gone.
Wow. Okay, crystal clear example. Now let's rewind a bit, look at another currency, the British pound sterling.
Ah, sterling. Yeah, after World War II, it was still a big deal.
Especially in the sterling area, right? Countries with close ties to the UK.
Exactly. A block of countries that pegged to the pound held reserves in London.
Yeah.
But the UK economy, well, it was struggling.
Oh, so?
Relatively slow growth compared to others. And again, those persistent balance of payments deficits, spending more abroad than they were earning.
So similar underlying issue to the U.S. later, trying to be a global currency provider while facing domestic economic headwinds.
Very similar tension. And just like with the dollar later, people holding pounds started getting nervous.
Worried about devaluation, that the UK would just decide the pound was worth less.
Absolutely. The sources mentioned multiple sterling crises, 47, 49, 57, then a big one in the mid-60s. Intense pressure, foreign banks, private investors. They became less keen on holding sterling. Too risky.
And the risk was real, wasn't it? There was a big devaluation.
There was. 1967. A significant cut in the pound's official value.
And the numbers really tell the story of its decline as a reserve currency, don't they?
They really do. Around 1950, maybe 25% of global reserves were in sterling. Some sources say even way higher right after the war, maybe over 50% or even 80% plus.
Incredible. And the exchange rate started at?
Under Bretton Woods, it was initially £1 to $4.03. Pretty strong.
But then the devaluations hit.
Yep. Down to $2.80 in 1949. Then, after the 67 crisis, down again to $2.40.
And its share of global reserves just plummeted.
Dramatically. Through the 60s, it fell below 20%. By the early 70s, under 10%. By 1980, around 3%, just a shadow of its former self. And the sterling area pretty much fell apart after 72.
Wow, so the UK just couldn't square its own economic problems with the demands of being reserve currency. Confidence collapsed.
That's a good summary. The Triffin Dilemma, UK style. Inability to manage domestic issues while supporting the pound's international role led straight to its decline.
Okay, but now, here's where it gets interesting. Our sources threw in a curveball. This idea of an inevitable deficit. Maybe not so inevitable.
Right. This adds some important nuance. Let's look at the UK before World War I.
Back when sterling really ruled the waves during the classical gold standard.
Exactly. London was the undisputed financial center. Sterling was the currency. But here's the twist. The UK consistently ran current account surpluses.
Wait, surpluses? They were selling more goods and services than they were buying.
Correct. So how did they get sterling out into the world if they weren't running a trade deficit?
Good question. How?
Through massive outflows of capital, a financial account deficit.
So not buying goods, but investing.
Precisely. The UK was the world's biggest investor, pouring money into railways, mines, governments, businesses all over the globe. This flood of investment capital was the supply of sterling.
So they pushed pounds out through lending and investment, not importing.
You got it. By 1913, their overseas assets were like 35% of their entire national wealth. Huge number.
Okay, so that really shows. Reserve currency status doesn't automatically mean trade deficits. Capital flows are key.
It complicates the simple story, definitely. It shows another way the system can work, especially if you're a dominant capital exporter.
And what about the U.S. right after World War II? Similar story initially.
Sort of, yeah. Dollar becoming dominant, yes. But initially, the U.S. also ran current account surpluses.
Why was that?
Well, U.S. industry was intact after the war. Europe, Japan, they needed rebuilding. They needed American goods badly.
So the U.S. was selling a lot to the rest of the world.
Exactly. So dollars flowed out through that trade surplus, but also through aid, think of the Marshall Plan, and through U.S. lending.
So again, not necessarily a deficit driving the dollar supply at first.
Not in those first few years. The pattern of persistent U.S. deficits we see today really emerged later, once other economies got back on their feet and started exporting heavily themselves.
Okay, so the inevitable deficit idea is more of a tendency, perhaps? Especially under certain conditions, but not an iron law.
That seems a fair way to put it. The Triffin Dilemma highlights that potential tension, that pull towards deficits as global demand grows. But history shows it's not the only path. It depends on trade, capital flows, the whole picture.
Really useful context. Okay, so bringing it back to today, how relevant is this dilemma now? The sources mention the 2008 financial crisis.
Yes, absolutely. It's striking that after the '08 crisis, the head of China's central bank explicitly pointed to the Triffin Dilemma.
Really? What was the connection they saw?
The argument was that the dollar's role as the main reserve currency created this huge global demand for U.S. assets like treasury bonds. This might have distorted capital flows, maybe pushed too much money into the U.S., kept interest rates artificially low, and potentially fueled the risky behavior and asset bubbles that led to the crash.
Yeah.
Come next to that global savings glut idea.
Right, the idea that excess savings elsewhere flooded into the U.S.
Exactly. So the dilemma, in this view, contributed to the imbalances that made the system vulnerable.
So, given these ongoing concerns, what about fixes? Reforms? Wikipedia mentions some ideas.
Yeah, there's ongoing debate. One thought is more global cooperation, maybe strengthening the IMF's role in managing currency issues.
Okay.
Another is revisiting Keynes' idea, reducing reliance on the dollar, maybe using those IMF SDRs more actively.
The super currency idea again?
Kind of. The IMF even put out a report in 2010 looking at these options, including, the long-term, maybe ambitious idea of a truly global currency, a modern bank, or maybe even a global central bank.
Wow, that's a huge change from today's system. Likely.
Politically, economically,
Yeah.
It's incredibly complex, massive hurdles. And the sources also point out the constant friction, right, between U.S. national policy trade deficits and the stability needs of the global system resting on the dollar.
And those U.S. trade deficits are still massive, $1 trillion a year.
Yep. And the U.S. has been a net debtor nation since the mid-'80s. These imbalances are still here, still fueling debate about whether the current dollar-centric system is sustainable forever.
So it really feels like, even though Bretton Woods is long gone, the core tension Triffin identified, it's still very much with us.
I think that's right. The specific context changes, the players change, but that fundamental conflict, domestic needs versus global currency responsibilities, it persists. It's still shaping global finance.
Okay, well, this has been incredibly insightful, a really good deep dive. So the big takeaway seems to be this core paradox for reserve currency issuers. You need to supply your currency, but doing that, often through deficits or massive capital outflows, can create imbalances and eventually shake confidence, even if deficits aren't strictly always required.
Precisely. And hopefully, by exploring this dilemma, you, the listener, now have a richer sense of the gears turning behind the scenes in global finance. It's not just abstract theory. It helps explain history and frames today's debates.
Yeah, those historical examples really bring it home.
They offer really valuable lessons as we think about where things might be headed.
Which leads to a final thought, I guess. Thinking about Bretton Woods, sterling's decline, the ongoing debates, What does the future hold for the dollar? Or could we actually see something new emerge, maybe a different reserve currency, or even that bank war idea? It really makes you wonder how shifts in trade and capital flows, maybe geopolitical changes, how they'll play into this age-old balancing act, balancing national needs with global financial responsibility. Definitely something to chew on.